There comes a time when the fairy tale ends, when the laughing and the good times of the people around you are silenced, when the music stops. After some of the most volatile years in the market, with new record highs from indexes, the dot-com bubble had pushed the US stock market into a perpetual bear market for 2 years. How did such a thing happen? This is the dot-com crash, a full analysis.
Why buy just a video game from Atari or Intellivision? Invest.
New from Firebird, the long-awaited Commodore version of Revs.
In 1989, Tim Berners-Lee would invent the World Wide Web. The idea was simple. The web would meet the demands of automated sharing among many researchers, universities, and institutions all around the world. However, it would soon grow to be the early stages of what we consider the internet today. The year 1993 would mark a new age, the rapid popularity of the internet. The release of MOSAIC and other subsequent browsers gave users access to the World Wide Web in a much more user-friendly way. From 1990 to 1997 alone, there's a 10% increase in the number of households owning a computer. Soon enough, computers went from a luxury in many households to a necessity. It was clear that the internet was to stay. Simultaneously, Wall Street was going wild, with the Fed decreasing interest rates as well as Congress passing the Taxpayer Relief Act of 1997. It was a perfect time to be an investor in the market. Because the drawdown for short-term trades was greatly decreased because of these events, speculative trading was a new way to make the money in the markets. One of the biggest speculative plays that investors wanted to profit from was a result of the Telecommunications Act of 1996. According to the FCC, the goal of this act was to let anyone enter into the communications industry. To many investors, they expected that this bill would be the introduction of new technologies, something they wanted to profit from. Little did they know, this was the start to the absolute mania that was the dot-com bubble. The hype for these tech stocks was at an all-time high. As a result, many investors would buy shares of tech stocks, regardless of its valuation. The idea was simple. Though these companies aren't making any money right now, as long as you got in, the company would go up tremendously when they do make money in the future, thus making you rich. Companies with an internet-related name or .com suffix were just amazing investments because, come on, the internet is the future, isn't it? However, this thinking wasn't just common among traders. Startups got large amounts of venture capital easily, banks made a killing on IPOs, and tech companies got accessible loans to increase their spending into their own business. It was a win-win-win situation for everyone involved. For many tech companies, their business was to grow as fast as possible, having little regard to any money they made. Advertising, networking, and brand awareness led to net operating losses in their fundamentals. However, like investors, these companies believed that once they grew to be massive, they could start charging customers for profit. But right now, the goal is to grow, and grow. This was the new way to invest. The old way of researching these companies, knowing their fundamentals, or what they did, was just an outdated method. Why do all that work when you know these companies are going to go up no matter what? This wasn't gonna end, was it? Was it? Soon enough, investors started being wary of the valuations of their tech stocks. There was a growing fear that maybe these companies they invested in weren't actually gonna grow. To make it worse, the Federal Reserve raised interest rates several times, to investors a bad sign. These fears were realized on March 13, 2000. Japan had entered into recession. This caused a global sell-off that affected tech stocks the most. The days after this news, the SPY performed better than the Nasdaq, causing people to sell off their tech and put more money into established stocks. On April 3rd, 2000, Microsoft was found guilty of monopolization in violation of the Sherman Antitrust Act.
In the operating system market and the applications market, where Microsoft has a monopoly, their market share has increased consistently since the day this trial began. They are currently over 95% market share in both of those markets.
To investors, this was bad for every tech company other than just Microsoft. And so, soon began the fall of tech. By November of 2000, tech stocks had lost a total valuation of $1.75 trillion. To make it worse, many companies came out with accounting scandals, further destroying investors' confidence in tech. The Nasdaq had fallen a whopping 75% from its peak. The party was long over. In the end, a lot of companies went bankrupt, while others were a shadow of their past selves. If anything, the dot-com bubble shows an excellent example of how fundamentals always catch up. If you like this video, hit the like and subscribe button, and have a wonderful day.